If you invested, you're not a day trader, you invested in high yield for 20 years, despite all the volatility in high yield we had, look at the return you made in European high yield, 6.7%. You left 81% on the table compared to investment grade. Yes, you have more volatility, but the return is superior. And similar, your return in equities for Euro stocks isn't too dissimilar to high yield, but it's less volatile. So I'm not telling you not to invest in equity or investment grade. Just don't ignore high yield. It's not a bad asset class. And I think this is the other thing, as I indicated earlier today, what has happened in high yield, the underlying credit quality in high yield has materially improved. Companies have become bigger and less risky. Where have the weaklings gone? The leveraged loan market and the private credit. They drive the garbage truck. And on the right-hand side, you can see the credit quality in investment grade has materially deteriorated over the past 25 years I've been doing high yield. Triple Bs today are almost half the market. 80% used to be single A or better in the investment grade. Credit spreads in high yield are tighter. Credit spreads in investment grade are even much tighter. So why short-dated high yield? Because if I can see in a company and model the cash flow over the next 2 years, you probably can agree with me, unlikely the companies can default. And the really arbitrage in high yield is that the credit spread for shorter dated high yield bonds or longer dated high yield bonds isn't too dissimilar. And as long as interest rate curves are not too steep, we're going to make the same amount of money investing in short dated high yield versus long dated high yield, but no defaults and materially less volatility. Our volatility is about half of that of a long-dated high-yield bond fund. You can see it goes back to 2009. This strategy has been running for that amount of time for our pension fund to invest the pension fund swap collateral in high yield. Sounds crazy, but if you do it right, it works extremely well. Why now? The amount of interest rate movement you need to have for high yield, for our fund, to wipe our return, it's material. So it doesn't really matter that much. And please remember, even spreads are going to widen out. I got a carry of over 5% and duration of 2 and a bit. So spreads have to widen for the whole year for 2 and a bips to wipe out my return. That's why short-dated high yield, this fund is attractive. And if you look at volatility of regular high yield to equities, yes, they're correlated by 0.8. But I also showed you that our fund is about half as correlated as global high yield. That means our correlation to equity marks about a half. That's very attractive. Fundamental active. We run 2 funds. Global short dated high yield generates you generally cash plus 3.5 to 4.5. And then we have a floating rate credit fund, which is the boring alternative if you're afraid. Rated BB minus, can't be buying triple Cs, and generates you Euribor plus 3%. One is more focused in Europe, the other one is a much more global fund. And here you can see the duration for the short high bond fund, 2.28. The credit duration for the floating rate fund is 3.5. Of course, the interest rate duration is about a half. You can see the difference. The yield, you can see the number of names. Please note, we don't run portfolios with 380 names in there because I wouldn't know what's in there, nor would my analyst, and you couldn't follow them properly. Always between 100, 150 names. These are the names in the high yield market you've seen in the past. Virgin Media is about half the size of British Telecommunication. Asda Groceries, they're about a third of Tesco's you all heard about. And then if you look at Ineos, chemical company. And probably one thing to say about that, I used to be the credit analyst in 1998 on INEOS. Given that my background, I got a PhD in organic synthetic chemistry. It's an obvious one to look at. EBITDA at that point was 37 million. Today, it is over 2 billion. And we've seen this in the high yield market. Most of the companies we have today, they've grown up. They were little kids. Today, actually, they're formidable competitors to the investment grade companies. And this is also part of the reason why default rates in the high yield bond market will remain low and are lower versus history. This is how we do it. 1,500 companies. The analyst team looks at these names. We sift. We don't do tech. We don't do banks. We don't do property. And we don't do non-food retail. And if there's a company which doesn't generate free cash flow over 2 to 3 years, it's not welcome either. We overlay that with our ESG strategy. We exclude certain sectors, whittle that down to about 400 names, and then we have in between 100 and 130 names in the portfolio. There's a macro overlay, probably 10%. The rest is bottom up. We are stock pickers. The important thing for me as a PM is the analyst has a cash flow model for each name. We talk to our investments 5, 6, 7, 8 times a year. Why is that so important? Then I can tell if you're off track on your business plan. If you deviate too much, the analyst will just tell us, please sell, and we sell. And this is the other thing, how we differentiate ourselves with our competition. It's not us as PM decide what we're going to buy and what we're going to sell. It's the analyst. We make sure as PMs we stay within our limits. Sectors, subordinated, senior, credit rating, etc. This is one of the examples. September 2024, Rob Jones saw the company at JP Morgan High Yield Conference, had a one-on-one with them. He came out of the meeting and said, please sell, Uli, this is going to be horribly wrong. And we did. We sold at 89. They make paper, cardboard, recycled cardboard, and you can imagine what has happened to the US, the global economy. Trade has slowed, probably cardboard boxes not going too well. So we ordered the garbage truck soon. And then look on the right-hand side what happened 3 weeks ago. Lights out. 11 times levered, will restructure. Recovery is probably under 50 cents in a dollar. Active and fundamental shows you avoid those defaults. And this is why you see the statistics. We had 3 in the history of this fund already inside. And we classify default when we lose 50 cents in the pound, not when the company actually defaults. So it's about 8 or 9 basis points at the fund level. We have them when we have external events which we can't control. 2014, 2 oil and gas companies. We've stopped that problem because we only lend to an oil and gas company today if you hedge for the next 2 to 3 years. So I can guarantee I have cash flow to pay my interest and my investments. Performance. Look at 2022. I think we left the competition far behind. We lost 5% versus regular high yield, lost about 12. IG lost 15. Short-dated high yield lost about 9. And you can see we're keeping at pace with index performance in the following year. So actually you had invested in this fund. You had a decent return over the past 5 years. You invested European investment grade. You basically made no money. Net of inflation, you lost money. That's the floating rate fund. As you can see, the benchmark in light blue is the leveraged loan index. 70 basis points ahead for the past 3 months. For the year, about almost 100 bips. You can see pretty impeccable as well. Again, same process, same team, same way of investments, no defaults. In summary, The economics are not great, but companies are prepared. The companies we lend to are hunkering down. They're doing the right things. We don't borrow more. If we have excess cash, we pay down debt. We cut cost. We see where we can save money, and that way we just get through that. We remain underweight triple Cs. I said we can generate the same return with 3% triple C exposure versus the market about 10 to 12. And we know the defaults are happening in the triple C space. About 25% of the pubs and triple Cs will go bust. Corporate fundamentals are solid. And they have materially improved in 2020 because COVID gave most CFOs a heart attack. And they realized, well, we can't continue this way. We have more liquidity today in the balance sheet. We have extended the bond maturity profile. And we just don't want to have as much leverage. There's corporate M&A upside. What do I mean by that? Well, our friends from investment grade, they need to grow, right? And if you have no GDP growth, I have to buy something. Guess what? I think we lost a 6th or 7th high-yield company in M&A transaction to IG companies. And what does that mean? They're going to refinance the bond. We get a capital uplift. I'm going to make a decent amount of money. And you will see, because of how do investment-grade companies pay for this? Debt. You see record issuance in investment grade, even on a net basis, whilst in high yield, European high yield has issued about 110 billion of bonds year to date. On a net basis, it's 14 billion. Hardly anything if you compare that to a market of about 450 billion. Interest rate volatility, who knows where interest rates are going to go? I'm very doubtful that inflation is going to come down. That means 10-year rates will remain elevated, irrespective of what's going to happen on the front end. So we might end up with a relatively steep curve. And then the other thing is, the underlying demand for high yield. And you heard what I said this morning. Please, this is called high yield. It's not called high spread. It's a magic word invented by people who do not really constantly invest in the asset class. So yields are still good. Euro's high yield gets you about 7% on index level. European high yield about 5%. It's tighter versus historics, but still very attractive. Thank you very much.